All right, what's up, everybody? I am super excited about this interview. First time I've had a conversation with Bruce Gehrke. He runs lender intelligence for JD Power. He's been very active on LinkedIn for me. I've really noticed, Bruce, for several months that you've been pretty active on LinkedIn. Has it been longer than that, or is it just really this year that you started digging in on LinkedIn with the mortgage industry?
Yeah, I think pretty much this year we took a different approach, I think, and got a little more out there than JD Power traditionally has in the past. And company-wide, it's been a push for ours to take more of a position out in the market and share, what we're learning about consumers. But for me personally, yes, the last couple of months really, and the last couple of months have created lots of opportunity and things to talk about. So the two came together, and that's what you're seeing.
Yeah, well, I'm looking forward to getting your thoughts on everything from, the Rocket acquisition of Redfin to just, what data is telling you about today's customer. So before we jump into that, if you could just tell a little bit about yourself and your role at JD Power.
Okay, so I head up our lending intelligence group, and that covers all lending products in the financial services area, and facing consumers today. Primary to that, and really the biggest focus of our group is on the mortgage industry, and we do surveys of mortgage borrowers as well as mortgage servicing customers each and every year. So we're constantly in the marketplace throughout the year for both studies, capturing consumer feedback on what they're seeing, feeling, preferences, their perceptions of their interactions with both lenders and servicers. And we publish those results twice a year. We make data available throughout the year for folks that subscribe to our study. So it's a subscription model. It's focused on industry participants. Our studies are focused really on the top 2/3 of each business. So we use independent third-party market share sources to source those folks. And then we go out into the market and we collect data from their customers. So it's all independent. We don't get data lists or customer lists from anybody. We source them independently. We verify who they're doing business with. Either they've originated a new loan. We look at the last 12 months. So it's a rolling 12 months as we go through the year. And for servicing customers, we want somebody to be with that servicer for at least 12 months. So they go through an entire 12-month period of interactions, go through, escrow management and things of that nature. And in the current market with a lot of transfers going on, we want them to be with that servicer for 12 years so that they have a sense of what that total experience is like. Then we put that out. The only thing we really, present to the public is the ranking, and that gets a fair amount of attention within the industry. So we do rankings of the folks in our study that are targeted on our study for both servicer and for origination. And this is all focused on customer satisfaction. So we create a customer satisfaction index from the data we collect, and the highest score there garners a JD Power Award, something that you've seen probably from across the auto industry and other financial services industries. And they're free then to use that and market that within their own marketing for that year period until we get a new winner or the same winner. But generally, that's the standard business model that we're doing.
Got it. I want to unpack the data a little bit just because I know there's going to be a lot of mortgage professionals watch this, everything from on the ground mortgage advisors, executives, C-suite. So I want them to understand the data. So when we see the quotes in the marketplace, that's from 2024. So is all the data that you're collecting right now, basically what was collected in 2024, or is it like we're seeing what was collected through June of 2024? What's the date range?
Yeah, it's a little bit different. So for origination, we're looking back. So we're constantly collecting now. We started fielding the 25 study in the beginning of September of 24, but you've got a 12-month look back period for there. So as we move through, we're getting people, up until now, we're through 2 waves of data, which we just closed out wave 2 of that study. So that closed out this March. So we're looking back 12 months from this March. So anyone
Oh,
who
wow.
originated a loan, but the data goes back all the way back from 12 months to from September. So we could get people who are in 24 and into 25. We'll wrap this up in September. And so we'll have folks basically from September of 25 really back 12 to 18 months, prior to that, so back into 24. There's a bit of a lag time there. For servicers, we just wrapped up our third wave. That data comes out in July, and that will have folks that are 12 months with their servicer for 12 months from the time that we're surveying them. So they're current customers with that servicer, and they've been at least 12 months with them.
Got it. And how many consumers are we talking about that are part of these studies, just so I can get a feel for the scale?
Servicing will wind up this year with about 16,000, a little over 16,000, maybe 16.5. Origination started out pretty slow, given that the market, the volume in the market is off. Last year, we had 7,500 completed responses. This year, we're running fairly well ahead of last year, so we should be closer to 9,500. We're looking at ways to increase that yield, but that's where we're going to probably wind up this year.
Okay, great. So guys, if you're a loan officer or a mortgage professional, I mean, this is an amazing service, and when you see a quote from JD Power, I recommend you look at it, you write it down, and then you audit your own business, the experience that you're creating to consumers, and score yourself. Like, hey, am I delivering on the findings? Because this is it's pretty powerful. So what are the findings? What are you seeing from the data right now that, and to me, the headline of today's call is, what does today's consumer really want from a lender? Like, what's your, what are you seeing out there?
Yeah, I mean, it's a great question, because I think, and just to touch on this, a little bit on my background, I've been with JD Power for 8 years now. I spent over 12 years in the mortgage industry, over a couple times, going back a while. And I've played a lot of different roles within the industry, and mostly on the origination and production side, from being, from selling. I started out as a loan officer, so I understand some of what goes on there. I spent some time as a sales manager as well, and ran secondary marketing. So I have a good feel for the flow of the business and how it works. And also, we were one of the companies I was with, we kicked off a servicing operation. So, but my job is to try to take the data and make it usable to, like you said, to anybody within the industry, and that goes to senior leaders down to loan officers. But what we're really seeing now is what I think is a pretty significant change. Having that look back on the industry and seeing an industry that's been fairly consistent in the way that it interacts with customers and what customers are looking for, how they move forward, through the process. The last year or so, I think we've seen more of and I think it's a reaction to the realities of what's going on out there in the economy, in the real estate market, in the home buying market, is really this transition from looking for a quick and easy transaction, get me the lowest rate possible. I just want to get in and out of this. We've all said this and we know this, but sometimes we need to be reminded. Nobody ever woke up and said, hey, someday I want to have a mortgage. They want to have what makes that mortgage what it makes possible, whether it's a home, whether it's a new kitchen, or whether it's no more, credit card debt. Whatever that is the end goal. And what we're seeing is a little more difficulty in getting to that end goal. And I think that has driven the perceptions and the preference mostly in what consumers and borrowers are looking from their lender. And we see more of a preference towards an advisory interaction and a longer, more involved relationship, not as transactionally focused. And I want to make sure we understand the transaction part of this is important. It's still the number one issue that folks cite when they say, what's most important when you choose a lender? But the percentage of folks that are answering that question is dropping year over year for the last 3 years. And right now, it's still the most significant driver, but some of the other more relationship concepts are gaining, the percentages of what borrowers also say is important. So things like the ability to interact with loan officers directly, whether that's in person or whether that's over a video call, but to have a more personal relationship with them. We're seeing a higher percentage of borrowers who want truly what we call a hybrid experience, meaning I want great digital capabilities and tools, but I still want that in-personal interaction. And that's up to 93% of all borrowers are saying, I want a balance between those two. The other thing is that we saw leading up to about 2023 is a growing perception of borrowers who are saying, look, if I could do this all digitally, I'd love to do that. That number has dropped maybe 10 to 12% over the last 2 years. So we're seeing less of a perception for an all digital experience and more of a perception of both. But some of the interesting points out of this is in the younger generations, both Gen Y and Gen Z, which on our data are making up about 55–60% of the buyers in our study, they're looking for more of a digital experience if the tools were better. So what that's telling us is digital capabilities are there. Some of the other data points to it's not keeping up with their expectations of what digital should be able to do for them. And one of the things we like to point out when we talk about this is a lot of that expectation is driven outside of the mortgage industry. Most borrowers do not have experience across the board with different competitors when it comes to comparing digital, capabilities and products. Your mobile app is better than their mobile app, but they can compare it to other providers, other service providers, other financial service providers, insurance companies, wealth management firms, things even like Apple or Amazon, which had a lot of success in dealing with consumers directly. So this creates expectations within the market, and there's some indication that those expectations aren't being completely met. And so some of the fallback to that is, hey, make sure there's somebody there that I can talk to.
Wow,
So
there's so much to unpack with that. I do for all the loan officers and the mortgage people in here. I think, Bruce has a lot of credibility because one, he's got the data now, 6 years or 8 years at JD Power, and then he was a loan officer. He's managed loan officers, and he understands our industry. So I just want to start calling out things that I heard. So first of all, big heads up to everybody. Like you're not being compared to other mortgage apps. You're being compared to Amazon, Uber, and I just started writing down DoorDash,
yep,
Zillow, Redfin, uh, things that are not in our industry, and then the absolute best of breed experiences within our industry, right? Bruce, that's what you're telling us. Would you agree that like that's what Gen Z wants now, but all consumers want that hybrid experience. They when it makes sense to be digital. I mean, grandma's on Zoom. If it makes sense to have a Zoom conversation, let's do it. And if it makes sense to be in person, that's where someone who's a local referral-based originator, if they can easily go from whatever the consumer wants, give them what they want. Does that all align with what you're seeing in the data?
yeah, and you bring up a great point. Um, the preferences do change. So, for instance, we had something out, on LinkedIn yesterday from our wealth management data saying, younger wealth management customers who are using do-it-yourself platforms, they're going to directly to Schwab and people like that, or Robinhood or something. They're not putting aside that need or that desire for a personal conversation. In fact, they actually want it more than some of the older borrowers do. And so I took a quick look at some of our data, and lo and behold, we see the same relationship there. So the younger borrowers, and I looked at Gen Y and Gen Z, they are 20% more likely to want to have a face-to-face with a loan officer than boomers, Gen X and up. And yet they have that preference towards digital as well. So, the way I look at that is saying, look, the digital tools or their expectation isn't quite, we're not quite meeting that level yet. And I think a lot of that has to do with the complexity of the transaction. It's just like the mortgage industry is falling short. I think it's just a lot harder to do what others are doing in this environment. I mean, it's a complex transaction and it's an opaque transaction, and a lot of what impacts it isn't readily available to the consumer. So there's a lot of challenges there. So it's not as if we're falling short on execution. It's just there's a long way to go. But what's happening is they want that personal interaction and in person. And a little data point that we've pointed out with some of our direct-to-consumer partners is the ability to do this, like you said, video calls drives a tremendous improvement in the experience and in satisfaction in the experience. And very small percentage of folks are actually using them. So it can be cumbersome. Some borrowers may not want it, but those borrowers that do it, they really, really appreciate that ability to have this talk. If, say, I'm dealing with a Rocket, with an Amerisave, or with a Mr. Cooper or a PennyMac in their direct-to-consumer models, here I have this ability to make this connection. And that goes beyond, pure sort of operational execution. This is more in the psychological realm of looking and understanding consumer behavior and what really resonates with them longer term. And what you're trying to do here is build a more longer term relationship, especially for loan offers. You want to be able to come back to those folks after the fact. You have the ability to mine that data as you go forward. It was much harder in the day back then when we were writing down people's, name and phone number and address, and that changed and you lost track. But really fine tuning that from the sales perspective, you establish that early on, and that is really going to bring benefits down the road. And that's another thing, that we've seen in the data so far, is that early interaction driving greater advocacy, loyalty, ability to recommend and desire to recommend and be a promoter for your brand and for your as a loan officer from your business. I mean, getting out there and talking to them before you're talking about a loan. Because when you're talking before you have a loan, you're impacting the consumer when they're forming decisions in their mind. And that decision, first of all, is whether I'm going forward with a transaction or not, viewed very differently than a decision of who I'm going to go with. Because now you're bringing in that whole sales function, and people build up walls when they feel like they're being sold. So what you're trying to do here is lead somebody into you as opposed to pushing yourself out into them from a sales perspective. And that's where we really see this connection growing and the benefit across all these metrics: advocacy, reuse, less likely to shop around for a second quote or even submit a second application.
So let's unpack this. So guys, for the rest of the conversation, we're going to end this conversation with, call it the loan manufacturing, which I'm going to say starts when the credit reports run. And we'll unpack what are the best practices from that point. But let's go in front, because I want to make sure loan officers are connecting the dots on what you just said, or at least what I perceived you said. What I perceived that you said, and the industry is really big on credit triggers. That's where the consumer has just run a credit report. They're getting a loan from someone else, so that's too late. Like why weren't you there before that? And so what I'm hearing you say, and if you could validate this, is that it's never been more valuable to you as a lender and a loan officer if you can have smart conversation with the consumer when they're not running a credit report, and you could use data to hey, this looks like a customer that's eligible to move up or move down, who has a propensity to move up or move down. And if I could be engaging with you at those magical moments in a valuable way, that is what I'm hearing you say, is that the lender that can do that is going to have better retention. They're going to have even better conversion. Is that accurate?
Yeah, I think that aligns with what we're seeing. So an interesting point in that, if you think about financial products this today, we all have, whether it's checking accounts or credit cards or other financial, partnerships. Almost everyone that I have is constantly throwing a credit score at me. Now, it's not the credit score I would get, in a residential mortgage credit report, but it gives me a very good idea of where I stand with my credit. Is it of here? Is it there? Is it good enough for me to proceed? So what we ask, and we're getting data on what the first thing that a borrower does online, and the largest percentage of borrowers, the first thing they do is they look for a mortgage calculator. Their first action is to start to understand affordability and what they can accomplish, what it's going to cost them, and start to look at the financial implications of this. And this goes back to sort of the formation of decisions. And this is why advisory really plays an impact on that part of the equation. Because if you can help somebody understand those things from a perceived neutral perspective, so you focus on customer needs at that point. What are you trying to accomplish? What do you have available? What is your situation? Here's where we see this could go. What else can you do? And be able to show some broad options in a consumable way that makes it easier for the consumer to understand. They're going to view you different than somebody else that says, hey, I can get you a loan for X, rate and this kind of thing later on, which here, you're coming into the process, you're moving up per se in that sales funnel. So you're getting in a little bit sooner. You're still going to have to compete. I mean, it is a very competitive industry. It's going to stay that way. And there's a lot of other touch points where folks can come in there. So it's not a given, of course, but it gives you an advantage or levels the playing field. And what we see more often than not, and this is in both studies, the folks who get that first at bat with the borrower, serious at bat, tend to have a much higher pull-through rate and converting that lead into an actual customer, and a closed loan. So just getting there first brings, advantages to it. If you can get there first in an environment where you gain some trust above a transactor who is always viewed somewhat skeptically, certainly in our environment, in our world, then that'll give you further advantage. Because think about the process. If you're a loan officer who's not dealing, with a lender, with a realtor community who's referring you customers, you've got to find a way to compete with that person. And you can't come in after the fact really and fight that recommendation. That's a tough hill to climb. But if you can get in there sooner, it gives you a much better chance to succeed against that. And I think we're seeing several firms try to move up that sales funnel and looking at effective ways to do that from a direct-to-consumer environment who don't, have that group of distributed retail offices and loan officers on the street and things of that nature.
Yeah. So when I coach and lead, I have said, hey, we've gone from an era where speed to lead is king to an era where speed to need is king. And speed to need is I'm getting to the consumer, in creative ways, using data, using customer experiences to get to their need. And of course that implies that by the time they become a lead, I've already given them value. I've already, we call it, I call it always be coaching. Like you, from the time that you are in the transaction, be a coach and an advisor to the consumer. But how can you be a coach and advisor throughout the life cycle of the relationship? And let's, client for life. Let's do that over a 30-year period of time. So that all aligns. Those philosophies align with what you're seeing in your studies.
Absolutely. I mean, that's where the movement has sort of gone. And it'll be interesting to see if we get a little more volume into the market, how that changes the competitive nature of just getting a home, getting an accepted offer. Depending on your local market, some are tougher than others right now, but there's other challenges out there. I mean, insurance premiums are going up in a lot of markets because of external factors. You have a lot of financial considerations going on and some unknown now within the economy, with inflation, with the effect of potential tariffs, whatever may be going on. This is the reality. And I'm, as I've heard you talk about this before, you can't control those things outside of your world, but they impact the world and the folks that you're dealing with. And you need to understand how they're impacting people to present options to them that make sense, that meet their needs. So this is important to understand their needs, their preferences, their perceptions when you're going forward. Because if you're constantly trying to present yourself in what you think is the best light, you're going to have a little mismatch at some point. So being able to sit down with somebody, being able to show them, the advantages of home ownership over time, you have to understand what their timeline is. There's some very basic things that you really have to spend some time and understand what a borrower is looking for, where they are in their life cycle, where they are in their family life, where they are, financially, what their end goals are. They vary. And how you structure a deal is impacted on how well you understand their needs. So having the ability to do that What we see is just getting out there and interacting is going to drive better experiences. That's up to then the loan officer. And the way we like and I present this is we're not mortgage experts per se. We're experts in understanding consumers' perceptions, their behavior, and what it means and how to maximize efforts to it. So it's up to the lender, it's up to the loan officer then to take that information, say, how am I going to react to this? And how am I going to meet those needs? And those folks out there that are helping them, that are providing tools to do that, are the ones I think the partnerships that you need to be considering. Gone are the days where you can keep doing what you did last year and the year before and expect to get similar, results from that. You need to adapt and move forward. And in a data-driven environment, that's learning to understand the data you have. That's foremost in what we try to do with folks. Understand the data that you have and focus on the data that helps. And the rest of it may help you later, but narrow it down to that you can take actions on and that you can control, and then drive that to a better outcome.
So let's get tactical and then let's go into the loan manufacturing process. So for forever, it's always been recommended as a best practice for mortgage professionals to do an annual review, to reach out and have an advisory client, not wait until they are calling you because they want to do a transaction, but do an annual review and see if there's ways that you could save money, whether that's rate and term refis, which have not been happening too much for the past couple of years, or debt consol or home, some type of need-based debt restructuring. Or, hey, there's a lot of people that do want to move up or move down, or do reverse mortgages. And so what I'm hearing you say is annual reviews make sense, do them. And then in the interviews I've been doing with loan officers, I've been hearing a lot of first-time sellers because everybody who's bought a home in the past 3 to 7 years, they all have one thing in common. They got a lot of equity, because values have gone up so much. And so I'm seeing a lot of loan officers that are really either at a gut level anticipating who is most likely to want to move up, or using our platform to predict, like, hey, who's eligible and who has a propensity to do that. And it sounds like you're saying that's a really good idea. Like the loan officers that do that, the lenders that help their loan officers do that are they're following the tea leaves. They're following the insights that you're seeing in the market.
Yeah, and your point about understanding the propensities out there is important. I think the use of data, we're seeing more and more, and you're seeing more of a focus on understanding that data. And for servicers, for example, the big servicers, not so quietly, but are quietly really, really focused on understanding that base. A, they want to maintain the value of that portfolio, of course, but B, they also want to be there when the trade-up buyer starts to come back into the market. Where are they going to go first? And as I said before, we're seeing that first at bat, if it's a quality at bat, meaning they understand, they have a good relationship with you, they trust you, they're more apt to say, okay, there's a natural propensity to think that your servicer understands you better than somebody starting over. But you really need to cover that gap because, with secondary markets and everything else, what the consumer never really fully understands is whoever does this loan, whether it's your servicer or not, for the most part, is doing a whole new loan, and the process is going to start all over again. And they'll wonder and they'll say, why is this so complicated? You should know all this about me. So what you do know is important, but being able to communicate, and we see this across servicers, and we talk to servicers about this all this time, wasting your communication with something that's not important or doesn't resonate with your borrower is making every next communication less impactful. They'll start to pay, think about how many emails you get a day from everybody and, this inflow of information. And if you get the same, repetitive, hey, do you want to refinance? Hey, do you want to refinance? And you've got a 3% loan, you're going to stop paying attention. There are factors that may impact that borrower and may push them out into the market again as a trade-up borrower. But you have to learn to anticipate those. You have to use the data you have, adapt and get tools that help you understand that, and then be there when those opportunities exist. And for the loan officer, They originated that loan. They need to stay in that process. We could see several, servicing transfers down the line, but somebody else is probably going after that loan at some point. You don't have that same relationship with everybody. Your company may, retain servicing. They may not, or they may change, down the line and that goes somewhere else. So it's up to the loan officer to really stay in touch and to stay aware what's going on in that person's life. And that's hard to do at scale. But there's tools out there, and I know you guys talk about this, that help position that. And I think everybody needs to be doing that to some degree at some point. So just because the refi market isn't there right now, that doesn't mean, if you wait until it is there to try to grasp it, you're going to wind up getting a lot less of it than if you're prepared along the way. So this is always being prepared. It's like those folks who were prepared for a primarily purchase market before the market swung, had more success in this higher interest rate market. So waiting to prepare yourself for the future until the future comes, not a good strategy. And data is one way, to get yourself and keep up on things like that.
And I want to make sure everyone really connected the dots because I think 80 to 90% of lenders and loan officers aren't doing this right. What Bruce called out there is, there's personalization where you put their name in and you feel because you're emailing your database with a personalized message that you're delivering value. But if if it's not individualized, like the consumer and the biggest brands out there, Amazon, they are not just running journeys on their database. They're giving that consumer an individualized experience based off of data, activities, and propensity. So it's super important for all you loan officers out there. Don't just turn on auto email campaigns because you become noise. And then when you really have a good reason to reach out, they've either unsubscribed, you're going into a spam folder, or they've just, tuned you out. So over communication is just as bad as not enough communication. And what I heard from what you said, the magic is use data, take action on that data, and send your consumers valuable things based off of their individual preferences. Is that right?
Yeah, absolutely. Absolutely. And it's not an easy thing to do. It really isn't. Servicing, especially, is a low touch environment. But the loan officer has an interesting role outside of that. Because if you built that relationship and that relationship was above and beyond simply a mortgage transaction, it was advisory from the very beginning. It gives you permission, basically, to keep in touch and talk about other things. And those other pieces of data are what's going to help you personalize things. And now with artificial intelligence and where artificial intelligence really succeeds well is helping you take unstructured data like that and really creating some advantage out of it. It's not so much with structured data, but unstructured data where you're keeping that contact, which is something that is more difficult for the servicer to do than you are if you built, that relationship early on, because it gives you, as I said, it gives you the permission per se to stay in touch and ask questions. You're different. You're on a personal level, and if you can drive that, it's going to help you compete against the big servicer who now is grinding out all this data and has the ability to invest in all these tools and everything else, and they're going to be pretty efficient, at mining those portfolios. But there's always a way, and the beauty of the mortgage industry, it is very entrepreneurial and it is very local. So all this stuff we see it happening at the high level, there are ways for local to really, emphasize that local interaction, that local advantage, and to maintain a competitive advantage based on that. And that's why, we talk about this all the time. Our internal rules are focused on us getting at least 2/3 of any market before we can, stake a flag in and say, this is what's going on. And we get about 70 to 75% of the market share in both our mortgage studies. But that last 25%, especially in origination, is highly fractured. There's thousands of originators out there that are making up that 25, 30%. And that, I can't see that changing that much. But if you're not smart and you're not competing, the big guys are going to gain an advantage from artificial intelligence and data. And the question is, are you willing to spend the time and the effort to compete on that level? And I think you can. The question is, will you do it?
Yeah, well, this is beautiful. So before we go into this call to the last chapter of today's podcast, which by the way, I'm loving, this is really the kind of change I've, dedicated my career in the mortgage industry is to help consumers make better decisions around their mortgage because I have this thesis that most people they misconsume debt. They make the wrong decision as to how to refi, when to refi. What should they put 20% down, 10% down? Should they pay points or not pay points? And the loan officer that can help them always optimize equity and always optimize debt to achieve the true American dream. Like they want to be homeowners with financial freedom. Like financial freedom lending is where it's at. So everything you're saying speaks right to what I've believed my entire career. So I want to see if you see the same competitive advantages. So I see lenders compete on price. I see lenders compete on speed. I see lenders compete on convenience. I see lenders compete on advice and coaching. And then, of course, local. And so most of the people, like we have some of the biggest brands in both consumer direct and retail. But most of the people that follow our YouTube channel and that we're really speaking right now are local, referral based mortgage professionals. And usually realtors are kind of their alpha partner. And so I think, especially with this rocket acquisition of Redfin, you see what Zillow's doing and creating this, super app, and they've become one of the fastest growing mortgage companies. While they're still relatively small, it's pretty amazing how fast they're growing. That if you're local, you're probably not going to win at scale on speed, convenience, because all these platforms have a tip to tail, like from home search to home financing. They've got a very convenient solution. They've got a high cost solution. They've got a very fast solution, and they're all tech enabled. But the difference is, when they're not local, they're not in person to where they can really get to know the needs of that consumer and be a coach and advisor. So my message to the industry, if you're, distributor, retail, local advisor, is you need to be obsessed with how do you leverage that local footprint and how do you be a coach? How do you always be coaching throughout the life of the client? Is that supported by your data?
Yeah, I think because we see different strengths and we're measuring satisfaction, so measuring the experience, and it's interesting because while price is a driver in decisioning, you ask, and we do ask, what are the most important factors in choosing a lender, and they'll say rates, and it shows up everywhere. But we don't see a lot of evidence that people actually shop around for rates. So when we ask them about that, they kind of take the first rate quote that they got. They believe it's good. Now, albeit there's abilities to go online, to third-party sites and have a better feeling for it. Certainly when I was in the business, nobody knew what the rates were except us, so from a sales perspective, it was a little bit different. And the consumer generally didn't get the optimal deal. They got a good deal, but they didn't get the best deal, perhaps, because unless they went out and it was very complicated to shop around, then they did that. So now we're not seeing a lot of it. So while price seems to be more of an expectation, so a table stake, really, you've got to be in the conversation. And then you look to other differentiators. And speed is important, but we've seen one of the things we've seen in the data from a consumer's perception, and I'm sure most lenders see this in their operational metrics, is that's increased quite a bit. So the operational nuts and bolts of lending has really improved. So lenders are getting much more efficient. They're turning the loans faster. They're approving them faster. Does that really matter to the borrower? It matters more to a refi borrower than a purchase borrower. But there is this point, in the application process where what I call it is the high anxiety, point, because you don't know I don't care how qualified you are. When you apply for a loan, there's some anxiety between qualifying and getting approved. And knowing where you are in that process, the key to that is transparency. So If you can compete, and we see this in different processes and systems, and that tends, whether it's direct to consumer or whether it's local, distributed retail, how do you give the borrower a view into where you stand in the process? Do you know what comes next? Do you know who's responsible for the next step, when it's going to take place? So the speed isn't as important as long as you're matching their expectation of how long they thought it was going to take. So as long as the train is on time and gets to the station at the right time or before, you're in a good spot. If you're exceeding that, that expectation miss is very impactful on the negative side. So you want to make sure that that's, you know, well communicated and accurate as to what your timelines are. But the things that really differentiate, because so much of that has evened out. And the other thing is, when we like to look back at conversion in the front, the borrower doesn't know how long it's going to take you to approve my loan. You may tell them, but they don't really know. And they don't really know if that's fast or that's slow. So, what really matters to them is how they feel about you. And it goes back to what I said about pricing. Do they believe you? Do they trust you? Because if they do, then they're going to accept that you're giving them a good deal. And after the fact, when we measure, because we're measuring after the fact, and this is after that sort of post-closing halo when they love everything about it because they got the loan and they got closed, they look back, they remember two things. And first and foremost is, did they get the deal you promised them? So that is the killer, because if that something happens there, oh, the rates are up or this or that, you're going to get blamed whether it's your fault or not. They chose not to lock in and rates went up. It's still going to be your fault to some degree. But did they get that deal that they thought they were going to get? And do they still view it as a good deal? So first and foremost. But the second part, and I simplify this down to this, was it easier than they thought it was going to be? And that's what they take away from this. Now, we break it down into its component pieces, but at the end of the day, was it easier than I thought it would be? Because that drives a recommendation. I'll refer you, if dealing with Dave Savage and getting me a mortgage was easier than I ever imagined, you're going to get my recommendation. If I thought it was or so-so, then I may not step out. Because one of the things we find, and this goes across all our financial services studies, when it comes to financial products, people are reluctant to recommend unless they have a very, very strong feeling and a very strong level of trust. So it's a high bar to hit to drive that recommendation. But you've got to understand for each different model, each different originator, where your differentiation lies, and that's where you double down. And because so much of the other pieces are leveling out and it's becoming more commoditized. And even the process is becoming more commoditized. So this is more about the perception you create as, a service provider.
So trust is the North Star. And I think we all intuitively know that. We
Exactly.
live in a society where distrust is the default in America. I can't remember the name of there's a company that has a trust score. And I think it was last year was the first year where distrust is the default in America. And so we as a lending industry need to win trust at scale. Um, Part of that is how can we be more valuable higher in the funnel, individualized messages that have value around saving money, building wealth with real estate, achieving the true American dream. I do want to remind everybody when you think of transparency, how can and he talked about surpassing the consumer's expectation, that like giving consumer options. If you're just saying, hey, here's your rate, here's your payment, here's your cash to close, with the disclosure, first of all, that's not unique. That's not transparency. Showing them different options, different point options, showing them the cost of those options over time. By the way, time that matters to them. Like if you showed every single consumer, hey, here's the cost over 5 years. Well, for a military family that might get moved in 2 years, 5 years is too late. They want to see it in 2 years. And if it's a first-time home buyer that's like doesn't even want to think about moving for 7 years, 5 years is irrelevant. So showing the cost of those options over periods of time that are individualized for that consumer. And then you talked about credit score, you talked about home valuations. If you're showing them, hey, this is what your likely net worth will be based off of a time that matters to you. That's the kind of transparency you're talking about. And tell me if you agree with this, Bruce. I think that's where you also go from being a loan manufacturer and a loan officer to being an advisor and a coach when you show options and you show strategies and you show it over different periods of time. Any thoughts on that?
Yeah, I think especially, and it's a great thing you bring that up in today's market. So if you're dealing with first-time home buyers, they're seeing record levels of affordability, right? Higher rates, higher rates. I mean, to me, back in the day, these rates are pretty good, but we never had these rates with home prices as high as they were. So the net result is that affordability is much higher. So how does that make sense for somebody to buy a new home in this environment? Well, you need to sit down and, like you said, show them. And I've seen lots of folks talk about this, but showing is better than speaking about it because it's a concept for the average consumer, understanding how wealth is built, where it comes from, the power of leverage that you can get in this country with a 30-year fixed mortgage rate, at the LTVs, the loan to values that we can do them at. You have an advantage that no other developed economy provides to their people. But this is what drives long-term value for most, wealth for most folks in this country. And that's been the source, that equity that you talked about earlier. That's a source and a large part of people's wealth that has been created over the last 10 years or so. So how do you understand how to build that? Well, you need to show them different options, different ways to do that, how your choices now will impact that. And if you understand their timeline, like you said, getting all these inputs, you can then show them projections of where they may be. This goes a long way to saying, I know prices are high. I know rates are high right now. You can't assume that they're going to go lower where you can refi, but given the current environment, here's where you could be in 5 years, 10 years, 15 years. And especially if you got young kids, you want to be in that neighborhood. I mean, here's how you meet that need and really lay it out. But lay it out in a way, data visualization is key. It's one of the things that we focus on a lot with our clients. How do we make this data come alive? You've got to do it as a loan officer at a local level. You've got to be able to show those things, be able to do it effectively and quickly change so they can see the impact of what you're talking about. That's going to drive that some of that level of trust. That's going to make you advisory because, hey, nobody ever told me about this, or nobody ever showed me this before. And you start to show somebody how they can build equity over time and where they'll be longer term. It's so much different than saying you're going to be in this house and taxes will go up, insurance will go up, and things of that nature. It just presents a position. We're not trying to use mirrors and create something that looks better than it is. Just show the realities of it, because and you mentioned this before, and something that's a passion for you, but financial, understanding and intelligence across, especially the younger people, I think there's a lack there that they just don't understand, and we tend to just assume that they understand how these mechanisms work. And I have conversations, my kids are all in their 20s, and some of the things they say just, surprise me. And it's like, really? And they'll talk about home ownership as if I don't know if I'll ever be able to afford that. And I may never own a home. And it's like, when you get into why they think that, there's some flawed assumptions in there. And a lot of this is because nobody spends the time to explain these things and to get to the point where this is what you can do about it. And again, back to what's controllable, what isn't. Show people what they can control and what they can do with it, and you're going to have much greater success.
Wow, really powerful. I know our time is almost up, but I hope every mortgage advisor and for executives watching this, showing is better than telling. And how do you make the data come alive for the consumer?
Yep.
And because rates are high and affordability is challenging, and if you're an executive, are you empowering your loan officers? Are you coaching your loan officers so that they're going beyond a loan officer? They're becoming modern, data-driven mortgage coaches. Like that is how you gain trust at scale. So Bruce, what are the best places to follow you? And because I'd love to see you on a lot of stages in the industry. I'm gonna introduce you to some leaders that do sales rallies. There's some big events coming up. I would love the industry to hear from you firsthand because you're so data driven and you really get it. But where should we follow you? And if someone wanted to kind of learn more about you and learn more about JD Power, what are the best places?
Well, you can always jump on our website or, I try to be, and as we mentioned, I'm going to be more active on LinkedIn. It's a little bit limited sometimes, but you can always reach out to me there and we can talk. We're always looking, to explain one of the founding, visions of the founder of JD Power back in the 50 plus years ago was to enhance consumer understanding of products and services. And really that's where we live. We are, like to say, a microphone for the consumer. We're not an expert in each of these individual businesses or products or services, but what we bring to the table is helping folks understand what today's consumer is thinking, feeling, what they desire, what impacts them, and what matters to them. And any, environment where we can help share that, we're happy to do it. We work with a lot of folks within the industry directly. I just did a presentation at the MBA's Mortgage Servicing Conference. We're always willing to do more things like that individually. We're happy to do presentations. We're happy to share some of the data we have. Obviously, we're in the business of working and there is a business aspect to it, but there's a high level of making an awareness out there, which I think has lacked, over the last few years of what we're actually collecting. And something else I mentioned to you as well, the feedback that we get from the industry is important. As somebody who spent some time in there and really has some understanding of how the business works and how the individuals think about it, it's more important than ever to me as things are changing to understand how folks are thinking about it, what they need to compete better. We're in a unique position to expand our data. We just announced, a partnership with Databricks as an institution. Our first focus is going to be in the insurance business, and then we're going to move into the financial services business. So we're going to put more data available through Databricks. If any of you understand, how that marketplace works, but we're looking at getting our data out there in new and helpful ways. And any way we can enhance that and promote that, we're willing to do. And I'm always willing to talk about it to basically anybody who wants to listen. We'll put it that way.
All right. Well, I'm going to put a link down below to a link. I'll also put a link to a few articles that Bruce has recently been quoted on in the mortgage industry. I'm probably going to quote him a lot on LinkedIn myself. So for anyone that follows me on LinkedIn, you'll probably hear me talking about this. When we came up the name Trust Engine, it was right after the merger of Sales Boomerang and Mortgage Coach, and we really felt like, that's it. Like lenders going forward need to be really smart with data, have individualized communication, and then they need to deliver a really slick digital experience. Like guys, if you're in the mortgage business, you're not competing with other lenders. You're competing with Instagram. You're
Yep.
competing with Uber. And in mortgage now, you're competing with Zillow and you're competing now with Redfin Rocket. And so you need to have, if you're local, you need to amplify your humanity, your empathy, and really connect with the consumer. And then you need to deliver how to build wealth with real estate. Like if you're not showing people options, how to build wealth with real estate faster, you're not where today's customer is at. And today's customer is only going to have higher and higher and higher standards. And the lenders and loan officers that deliver on that, they're going to gain market share. So if you want to learn more about Trust Engine, reach out to me. I'm pretty passionate about turning loan officers into data-driven mortgage coaches. So you can connect with me at savageinsights.com. That's, always who I'm interviewing next. I'm sure this interview with Bruce is going to be at the top of Savage Insights for a while. Also, I have a mobile club that, couple down, you can sign up for that. And if you're a loan officer or a lender that wants to turn loan officers into mortgage coaches, I'm always telling you the recent content to do that. And Bruce, I love our new relationship. We just started talking a few weeks ago. I love the comments. Really appreciate, not only you commenting on my LinkedIn, but I saw you comment on Greg Shear, and I saw a podcast with Brian View from FinLocker. So I hope you continue to pump into this industry, and let's all change for the better. Any closing thoughts, my
Great.
friend?
No, just it's been great, just having these conversations with you. It brings back a lot of memories of what's transpired. I still reach out to folks. There's people that I worked with 25 years ago that are still out there originating loans, and you can never be too close to the street, as they say. So it's easy from us, and I think JD Power, in their focus to be objective and third party, has had a kind of standoffish uh, perception of everything before. And we can still maintain that objectivity, but at the same time, really be close to the industry and understand what's going on. So this has been great. Love to do more of this. I watch what you have to say. You line what you're talking about with your clients and your folks, and what you're putting out there aligns with what we're seeing in the industry right now. So, obviously that's a great confluence of ideas, and I think they all make sense. So we're not telling anybody something that isn't understandable. There's nothing new here, no earth shattering, but a lot of stuff is aligning to the point where I think the emphasis is growing and growing. And if you're slow on this curve, you're at risk going forward. So happy
Well,
to talk about more, and I love the appreciation. I mean, I really appreciate the opportunity to sit down and talk with you today.
yeah, well, it's mutual, and you just made me think of another closing thought, and then we're going to close this out. But guys, I hear people talk about, oh, there's these tech-enabled lenders, and I think the CEO of Rocket recently said, we want to be the Apple of mortgage. And here's my message to every distributed retail, every referral-based loan officer: we're all tech-enabled. You have a point of sale software, you all have LOSs, you all have product and pricing engines, you all have CRMs. A lot of you have MortgageCoach, and some of you have MortgageCoach Next Gen, our new product that we're rolling out in some of our data services. But here's the deal, guys. You know what's the difference between the Rockets and the Redfins and the Zillows? It's execution of best practices with technology. So for the IMBs out there, like, if you want to win tomorrow, it's, yeah, you got to have the tech, but then you got to get loan officer adoption of best practices with the tech at scale. And so that is where winning is. Obviously, with my job here is chief growth officer, and it's all about adoption. So keep following me. And Bruce, thanks again. Guys, this is a wrap. If you don't already follow our YouTube channel, follow the Mortgage Coach YouTube channel. And again, if you want to learn more about Trust Engine, check that out. Also, I'm involved in a nonprofit called First Home IQ, where we want to see more people get into home ownership in their 20s. So check that out. And guys, have a good one. Take care. And first one with Bruce. Take care, Bruce.
Thanks, Dave.